This week, the National Statistics Office released India's GDP data for the third quarter, ending December 2022. While there was a lot of speculation around the GDP slowing on the back of aggressive rate hikes by the RBI in order to tame inflation, clubbed with the slowdown in exports and consumer demand, the quarter 3 GDP numbers were in line with the RBI's expectations. In this episode of The Third Empire, we will break down the finer details of the quarter 3 GDP and try to understand the impact of various factors on the economy's slowing growth rate. While we do that, we will also look at one specific stock which has given about 75% returns in the last 1 year, while the broader indices have more or less remained flat. While this is in no way a stock recommendation, we will break down the factors working in favor of this company while also highlighting the potential headwinds going forward. Want to know which stock I'm talking about? Stay tuned. You're watching Informed Investor, The Third Empire, an initiative by ResearchAndRanking. Let's begin. India's GDP growth rate had moderated to 6.3% in the second quarter after double-digit expansion of 13.2% seen in the first quarter of the current financial year. It has now further moderated to 4.4% for the third quarter ending December 2022. This sprint was in line with the RBI's forecast of 4.4% for the third quarter. To assess India's productivity, the GDP is calculated using two methods. One is the factor cost method across 8 industries, which we will cover in the following sections, and second is the expenditure method. Under the expenditure method, there are 4 main components that are used to calculate GDP. These components are the main engines that drive economic growth. They are private consumption, gross fixed capital formation or investments, government consumption and investments, and lastly, net exports. C is the total of private consumption, which is the spending by consumers like you and I. These include expenditure on automobiles, furniture, food, clothing, and all the things we buy, but do not include physical items such as spending on doctors, lawyers, education, etc. Private consumption is then added to gross fixed capital formation or investments, which is I. This includes spending by firms and households on new capital formation such as plant, machinery, inventory, residential plots, etc. These two components are then added to government consumption and investment. This includes spending and investments made by central and state governments on various welfare projects. Net exports are the exports minus imports. Since India typically imports more than its exports, it is the smallest engine of GDP growth, and more often than not, it is negative. When you add all of these factors, it gives you the total GDP. In other terms, GDP is defined as the total market value of all expenditures made on consumption, investment, government, and net exports in 1 year. When we look at the breakup, consumer spending has slowed. This means people are spending less, especially on non-essential commodities. Private consumption showed the biggest moderation in growth, slowing to a 2.1% year-on-year growth in the third quarter fiscal 23 from an 8.8% year-on-year growth from the previous quarter. Private final consumption expenditure in the third quarter of the fiscal year 23 also exceeded the third quarter of fiscal year 2020 levels by 14.8%. benefiting from the sustained healthy demand for contact-intensive services in the quarter, amidst a continued improvement of the consumer confidence levels of households as revealed by the RBI survey. Most of the gain in consumption has come from the urban demand, with indicators such as GST collections, retail credit, PV sales posting strong growth in the third quarter of fiscal year 23. However, rural demand is yet to see a recovery. So we see a divergence in the growth of urban and rural consumption indicators, with urban consumption doing better than rural. Going forward, a broad-based moderation in the CPI inflation would be a key to support discretionary consumption, particularly of the low and middle income households. Gross fixed capital formation, or the GFCF, grew by 8.3% in the third quarter of fiscal year 23, supported by a favorable base effect. But the ratio of investment to GDP ratio has fallen to around 32% from 34% in the previous quarter. Having said that, investment is likely to benefit from higher allocation to capex by center and an uptick in capex announcement by the private sector. Moreover, RBI survey shows that business optimism is rising, with business expectations index remaining at an all-time high, and rising capacity utilization also point towards an impeding capex cycle. Slowdown in global demand and rising interest rates are the headwinds for the investment revival going ahead. Government expenditure too has taken a backseat. From April to June, government expenditure has expanded by 1.8%, but it contracted by 4.1% during July to September. Due to COVID-related expenses, the government significantly raised its spending over the period 2020 to 2022. So it is only logical that it is now attempting to reduce spending as the economy improves. GDP has also been hindered by a substantial decline in net exports in Q3 compared to a year ago level. The decrease in net exports is anticipated to remain a concern due to worries about a global economic slowdown and a weaker domestic currency. Overall investment grew by 8.3% on the back of growth in capex spending. In situations where the GDP fails to measure the real economic scenario, the gross value added GVA is a better gauge. The GVA measures the total value of goods and services produced in an economy and the amount of value added to a product. It is defined as the output produced after the deduction of the intermediate value in consumption. The GVA in India is measured at basic prices. Within real GVA, growth in the farm sector stood at a 3-quarter high of 3.7% year-on-year in the third quarter of fiscal year 23. The industrial sector posted 2.4% growth versus a 0.4% contraction in the second quarter of fiscal year 23. And growth in the services sector weakened to 6.2% year-on-year. After contracting by minus 0.4% in the second quarter of fiscal year 2023, industrial GVA reverted to a growth of 2.4% in the third quarter of fiscal year 23. This was led by a broad-based improvement across all subsectors. While the industrial sector moved from contractionary to expansion territory, it only grew modestly by a 2.4% due to a negative growth seen in the manufacturing segment. Subdued performance in the manufacturing sector can be attributed to a slowdown in exports, lower discretionary demand, and some fizzling off in the pent-up demand. Services sector continued to witness buoyant demand and recorded a growth of 6.2%, primarily led by trade, hotels, transport, communication, and services related to broadcasting, finance, real estate, and professional service. Healthy growth in various service sector indicators like air passenger traffic, port cargo traffic, GST collections, and retail credit will support the service sector going ahead. Overall, real GDP growth was in line with the RBI's forecast, but slightly weaker than the market consensus. A global economic slowdown has led to economists factoring a low growth for India. A host of banks, agencies, and multilateral institutions have recently cut their GDP forecast for the fiscal year 23. If you remember, Finance Minister Nirmala Sitharaman presented the economic survey with an optimistic real GDP growth projection of 8 to 8.5% for the year 22-23. Reserve Bank of India Governor Mr. Shaktikanta Das followed up 10 days later with a forecast of 7.8%. These estimates were thrown out of the window by the sudden conflict between Russia and Ukraine and the global tightening of monetary policy and the fall in India's exports. The real GDP will likely close the year at a 6.5 to 7%, down 150-200 basis points from the forecast. That's the thing about economic forecasts. There is always a risk of things turning topsy-turvy because of the black swan events. So here are the key takeaways. It is important to note that a normalizing base dampened the year-on-year growth in GDP and GVA in sequential terms. But the performance relative to the respective pre-COVID levels of fiscal year 2020 improved remarkably in the third quarter of fiscal year 23. The growth in GDP relative to the respective pre-COVID quarter rose to 11.6% in the third quarter of fiscal year 23 from 9.4% in quarter 2 of fiscal year 23. Notably, the GVA for services rose above the corresponding pre-COVID level in the third quarter of fiscal year 23 by a healthy 12.6%. Relative to the pre-COVID levels of quarter 3 fiscal year 2020, industrial GVA was a healthy 13.6% higher in the third quarter of fiscal year 23, driven by a broad-based growth across all subsectors. The 11.6% growth in the absolute level of real GDP in the third quarter of fiscal year 23 over the third quarter of fiscal year 2020 was led by exports at 30.2%, followed by private final consumption expenditure at a 14.8%. Gross fiscal capital formation at 12.5%. India's growth trajectory for the fiscal year 24 may face challenges due to the ongoing slowdown in external demand and its impact on exports. However, there is a positive outlook for consumption and investment demand. Households' current perception of non-essential spending have improved, and the year-ahead expectations have returned to optimistic territory after 15 rounds. This is good news for the households' incomes and profitability of associated companies. Despite this, the demand for consumer goods may remain limited as the preference for services persists. Lower CPI inflation would be essential to support discretionary consumption, particularly among low and middle income households. The prospects for private capex have brightened with the new project announcements and increasing capacity utilization levels. The fiscal year 24 Union Budget has indicated a significant increase in the capex target too, which will aid in pushing project commissioning amid a strong pipeline of central infrastructure projects. However, timely execution remains crucial. Merchandise exports are expected to contract in the fiscal year 24, which could impact India's GDP expansion, employment levels, and opportunities in certain sectors, household incomes, and the timelines of the awaited pickup in investment activity. That being said, the RBI governor has said that the Monetary Policy Committee has pegged the real GDP growth for the fiscal year 24 at 6.4%. The positive growth forecasts are due to several factors such as an increase in production activity that will boost private consumption, higher capital expenditure, and widespread vaccination coverage that will allow people to spend on services that require contact, like restaurants, hotels, shopping malls, and cinemas. Additionally, the return of migrant workers to cities to work on construction sites has led to a significant reduction in the housing market inventory. This would mean that India will continue to be amongst the fastest growing major economies in the world. The next story is about a stock that has been the butt of many such memes in the past, but it has smoked them all into oblivion this year with its outperformance on the stock market. I hope you've guessed it by now, and yes, we're talking about ITC. ITC shares have risen about 70% over the past 1 year, significantly beating the sectoral index Nifty 50, which has gained just around 10%. This year, ITC has been the best performing stock in the NSE Nifty 50 index with a 15% gain this year. What's behind the rise in ITC shares? While we decode the reasons for you, do know this information is for educational purposes only, and it is not a stock recommendation as that entails a detailed valuation exercise. Established in the year 1910, the Imperial Tobacco Company, as it was called back then, stayed true to its name and sold cigarettes for 6 full decades. Until the mid-1970s, when the company finally decided it was time to expand and foray into other territories. Over the past few decades, the transformation of what was primarily a cigarettes company has been nothing short of dramatic. Today, ITC is a diversified conglomerate with business spanning fast-moving consumer goods comprising foods, personal care, cigarettes and cigars, education and stationery products, to hotels, to paperboards, packaging and agri-business. With this aggressive strategic plan, it has emerged as India's second largest FMCG company. But do know that ITC still continues to be a cigarette company for the most part. Around 40% of the company's revenue can be attributed to cigarettes alone. And with the margins of about 60% on every cigarette sold, cigarettes alone are responsible for about 80 to 82% of the profits. With rising interest rates, stocks that command very high multiples but do not generate free cash flow have seen subdued growth. Investors have understood the need to be positioned defensively. In times like these, value investing has come into focus. As such, they are now valuing companies generating a lot of cash flows that are beaten down. Here, ITC, a defensive stock with strong cash flows, stable business and an attractive dividend yield, has seen an uptick. Do you remember that when our finance minister announced that the excise duty on cigarettes would be hiked by 16%, ITC actually dropped 5% in a matter of seconds, but it quickly rebounded. The reason behind this was the government hiked the National Calamity Contingent Duty, which is the NCCD, on cigarettes by 16%. NCCD accounts for almost 10% of the overall taxes on cigarettes. This was expected to have a minimal impact on ITC, as analysts expect an increase of 1 to 3% in the price of cigarettes that will readily be absorbed in the market with negligible impact on volume growth. As the cigarette segment is a big contributor to ITC's profits, and investors are therefore excited and understood that a stable tax environment is helpful for ITC's cigarette business volume outlook. ITC has gotten a further boost from a stronger than expected third quarter earnings due to better performance in its cigarettes business and a recovery in the hotel segment. While we have spoken about what's working in ITC's favor, we would also like to draw your attention towards unprecedented inflationary headwinds which continue to pose challenges for the FMCG sector, including ITC. The FMCG industry as a whole witnessed some moderation in growth owing to subdued demand conditions in rural markets, high inflation eating into household budgets, and a high base effect in categories like staples and convenience foods. The rise in prices of key inputs such as edible oils, packaging materials, soap, noodles, fuel, logistics, etc. have exerted considerable pressure on the margins. As a result, many FMCG companies have opted for shrinkflation to cope with rising input costs while managing consumer demand, while some other companies have passed on the rise in input costs to the consumers by hiking price of goods. To understand shrinkflation better, we had recently released a video explaining the same on ResearchAndRanking's YouTube channel. We would urge you strongly to watch the video and have a look at it. For ITC specifically, a favorable product mix has helped negate some of the raw material inflation. Having said that, the continued high inflation remains a key monitorable for ITC and for the FMCG sector collectively. To conclude, this was our attempt to bring out the factors working in favor of ITC while also looking at some of the headwinds going forward. We need to remember that this is for educational purposes only and this is not a stock recommendation as that entails a detailed valuation exercise. With that, this is Rahil Hassan wishing you and your loved ones the very best.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.